Under equity, we also have stock splits, which is very similar to a stock dividend, but even larger. One share can become 10 shares. Tesla had the famous 20-for-1 stock split a few years ago. We do stock splits to bring down the value of the share price. Amazon has done it a great many times, so has Google and Microsoft. No one wants a share to be worth $50,000. That makes it very illiquid. Not many people can pay $50,000 to buy one share. But if you make the share price 50, then anyone can put $200 in a company of their choice. When we buy back shares, it is held under an account called treasury. Again, this wording comes because of historical tradition. Back in the days when you bought back shares, you put them in the safe in the treasury, so that these shares are not stolen. Now, it is all electronic, as you imagine. If you buy back shares, you reduce cash, and you reduce equity. The account is treasury shares. Of course, if you buy back shares, you take cash out of the company. There is less cash, so the company is poorer and equity is less. In other words, if you sell shares, there is more cash and more common stock and more equity. If you buy back the shares, it is the opposite. There is less cash and less equity. The item under equity is called treasury shares. So now, under the equity section of the balance sheet, we will have the common stock, the paid-in capital, the retained earnings. Then we will have a minus under an account called treasury shares to indicate how much is the dollar value of shares bought back. If you buy back shares for cheap and then sell them for more expensive, the company will create a surplus. There will be more cash and more equity, but there will be no extra income on the income statement. Buying, selling share is not like selling cars and pizza. There is no extra income. So if you buy back one share for $100 and you sell it again for $120, you increase your equity by 20 and your cash by a net of 20. But the income statement stays blank. Companies have many reasons to buy back shares. To buy back and to give to employees for stock option plans. To give shares to people who have convertible debt. Sometimes companies buy back shares because the stock is undervalued. Finally, it is also a means to pay back cash to shareholders. Dividends is one way to give cash to shareholders, and so is buybacks. It is essentially almost the same thing. You can buy back shares to protect against hostile takeovers and also to manipulate the earnings per share number. I would like to spend a few minutes on preferred stock. Essentially, you need money, but you do not want the new owners to have voting rights. Then you issue preferred shares. But why would new owners want the shares if they cannot vote? Well, there is a sweetener. They have access to dividends before common shareholders. So essentially, you get dividends, but you cannot vote. This is a good deal for many people. One thing about preferred dividends is that it is essentially like debt. You get cash, and the investor cannot vote. However, unlike debt, the preferred shareholder cannot liquidate you like a banker. Another feature of preferred dividends is that they are not tax deductible like interest expense. Why do companies issue preferred stock? It's less risky to the corporation than debt, which may appeal to financially weak companies. Also, preferred stock is treated like equity rather than debt on the financial statements, so no issues related to debt covenants. Finally, dividends paid do not serve to reduce net income as interest expense would. So it is essentially a system of pros and cons. If you need cash, what do? You issue common shares, preferred shares, or borrow debt.